Hi guys, welcome back. Today we are going to have video lectures on portfolio theory. So let me share screen. Okay, in the previous video lectures, we introduced the type of investors, and as I say, we are going to consider what is the optimal investment strategy for risk-averse investors. And one of the most important strategy, it is called portfolio investment or portfolio strategy. And in order to have a deep understanding of that portfolio strategy, we need to learn portfolio theory. And again, this theory depends on the assumption, rely on assumption of risk-averse investors. And the contents includes that we first start with the most simple strategy. That is, you invest all your money into one security and then consider what is the risk and what is the expected return for your security. Okay, your portfolio includes only one security. In that case, what is the risk and expected return for your portfolio? And so basically we are going to cover standard deviations calculation, and in this pre-class lectures. And then we move on to second step. That is, instead of putting all your money into one basket, you can kind of invest at least in two risky assets, right? So for example, you hold one Toyota stock and hold SoftBank stock. So you hold two risky assets. So in this case, what is the risk and expected return for your portfolio? And after we finish step 2, we move on to step 3. Okay, so we don't need to limit the number of assets we're going to include in our portfolio. So we can have as many assets as possible. So we use, it was represented by N here. So we can include many assets. So if this is the case, what is the risk and expected return for your portfolio? Finally, we want to discuss another risk measures. So in this part, in the risk and return for individual security, we already know we're going to learn, or we're going to review that standard deviation is an appropriate measure, risk measure for investors who investing in only one asset. However, for investor who invest in a very diversified portfolio, or in other words, if an investor invests in thousands of assets, so what is the appropriate risk measure for that kind of investors? So usually we refer to investor who invest in just one asset as less diversified investors. So less diversified investor because their portfolio focus on just one stock, so it's less diversified. And systematic risk is important for well-diversified investors. Okay, and we're going to discuss more in details in the online lecture. So this is the big pictures. We're going to have 2 videos. One is here covering about the standard deviation and expected return. There's another pre-class lectures around here. We'll discuss about covariance. So first, let me explain about the first pre-class lectures. Okay, let me erase all this stuff. It was a mess. Okay. Section 1, the return for individual security. So in this video, we assume that investors only invest in one security. Then let's calculate the return for individual security. So you are familiar with bond. So let's start with the most simple one. So what is the realized return for bond? I think it depends on the assumption, or it depends on there are two cases to calculate the realized return. So the first case is you buy the bond and hold until maturity. Then we can calculate. It's very easy to calculate the realized return. Another one is you don't necessarily need to hold the bond until maturity, especially when the bond yield decline, bond price will increase. So in this case, you'd better sell the bond and realize capital gain. So let's discuss one by one, okay? So this is a simple example. This is a 2-year bond. So the coupon rate is 10%. Okay, coupon rate is 10%. So coupon rate tells you that you can earn a coupon at the end of each year, and the coupon rate times face value is the cash flow you're going to have as coupon payment. So let's assume that the coupon was paid at the end of each year. So that means that you can get coupon payment, which is the coupon rate times the face value. Face value is 1,000. So this means that at the end of year 1, you're going to have $100 coupon payment. Similarly, so let me put C here. So obviously at the end of year 1, you can get 100. You can also get another 100 coupon payment at the end of year 2, and based on the contract of the bond. And face value means that something like the principal, or at the end of the maturity, so you can get your face value back or your principal back. So something like here, so you can get back your face value. So actually, this is the total cash flow. You purchase a bond at time 0. You purchase a bond at time 0, which is minus 1,000. You buy a financial asset and you get the claim for future cash flow. So this future cash flow are represented by 2 coupon payment, and finally, at the end of maturity, you can get your principal back. So what is the bond yield, or what is the realized return of this bond? So I think if you hold this bond, okay, until maturity, you can simply write down something like this. So at time 0, okay, bond price 1,000. Sorry, let me erase. Okay. Bond price equals 1,000 equal the present value of future cash flow, right? So we already discussed that all the financial assets price equal to the present value of all its future cash flow. So for the cash flow here, at the end of year one, so we're gonna have 100. I don't know the interest rate, the bond yield. So I say 1 plus R. At the end of year two, we have coupon 100 plus face value and divided by 1 plus square. So if we solve this equation, we know that the realized return on it is 10%. So if we hold the bond until the maturity, then our realized return should be 10%. And this is already known when the bond was issued. So this means that if you hold the bond until maturity, yes, there's no uncertainty about your realized return. It's 10%. Okay, now let's see next slide. So let me erase. Okay. In this case, okay, let's assume that you buy it at a price of 1,000 and sell it at a price of 1,100 after receiving the coupon payment at the end of year one. Okay, so in this case, we need, in order to calculate your realized return, we need to draw this timeline and write down the cash flow. Okay, so at time 0, you pay 1,000 US dollar to get a bond. And at the end of year one, I think you can get your first coupon payment, which is 10% times 1,000. It's same with the previous line. So you can get 100 coupon payment. And after you're receiving the coupon, you sell the bond at a price of 1,100. So there are two cash inflow at time one. First one is you get your coupon payment. And you also sell the bond at a price of 1,100. So in total, your total cash inflow is 1,200. Then let's calculate a return for this investment. So you purchase, so at the end of year one, your total asset increased to 1,200, and you invest 1,000, okay, and divided by your initial investment, which is 1,000. So that means that your total asset increased by 20%, which is the realized return of your investment from this 2 years coupon bond. Okay. Now I think you need to understand that when we're talking about the realized return for a bond, we need to separate our discussion for two different scenarios. The first one is you hold a bond until maturity, then your return is 10%. On the other hand, if you hold the bond but sell somewhere before the maturity, then you need to calculate the total cash flow when you sell the bond and calculate the realized return. Okay, let's move on to the the next topic, which is how to calculate return for stock. So I think you're already familiar with those. So here is it's not latest news. So it's about Toyota. So let me share the news. So give me a second. So we know that company can issue both coupon bond and zero coupon bond. And Toyota issued a bond, okay, in the last year's October 25th. So he tried to issue a zero rate coupon bond, okay? And this means that if you buy this bond, your expected return is close to zero if you calculate that, because they will issue the 20 billion yen in 3 years bond, and the face value is 100 yen, and coupon rate is 0.001%. And this bond will be sold for 100.003 yen. So if you calculate based on the given information, that is the price is 100.3, and the face value 100, coupon rate 0.001, then you can get the bond price. Okay, so let me show you how to do this. Give me a second. Okay, so let me show you the bond's realized return if you hold it until maturity. So given the information, we know that at time zero, the bond price was sold at a price of 100.003, and the coupon rate is 0.01%. So each year, the coupon payment is 100 times 0.001%. And for first year, second year, and last years. And in the final years, in addition to the coupon, we also can get our face value back. So that means that at the end of year 3, we can get back 100.001. So based on this information, we can calculate the bond's realized return or bond yield by using IRR. So if you type equal IRR, so and given and include those information about the cash flow, then we can estimate that the bond's annualized realized return or bond yield is 0.00000. It's almost zero, okay? And you might wonder that why so many investors want to purchase this bond, okay? Please read the news by yourself. And one hint is you don't necessarily need to hold until the maturity, right? You can sell if you expected that the bond price will increase in the future. So you can also earn a higher realized return. To know more detail, please learn by yourself and take my financial market institution class, and I think you can find the answers. Okay, let's continue. Next, I would like to discuss about the return for stock. So I think the realized return for stock is very easy to calculate. So once you have to the finance class, so if the stock pays dividend D at the end of each year and forever, and if you bought it at the end of last year at a price of S0, and if you sold it 1 year later at SPS1, So the realized annualized return is that you just need to consider the dividend payment. So at the end of year one, you can get dividend payment, and you also you need to calculate the capital gain, right? So this is the selling price. This is your purchasing price. So the difference is called capital gain. So basically, there are two sources of gain for investment in stock. One is dividend, one is capital gain. So capital gain measures the difference between your purchasing price and selling price. And the nominator is your total gain over this 1 year's period. And the denominator is your initial investment, okay? So based on this equation, we can further decompose this one into two parts. So this part is called the dividend yield. So if you check some financial website, you can see that this is a dividend yield. It's the expected dividend over the stock price. So maybe 4% or 3%. And this part is called the capital gain. And I think it depends on the stock. So some stock has higher dividend yield and lower capital gains. And some stock has relatively low dividend yield, but high capital gains. So generally speaking, for large, stable money-making company, they usually have high dividend yield. And on the other hand, they cannot provide high potential capital gain. For mature company, I think every year they can generate a lot of cash, so they can distribute dividend very, very high. And for high growth company, instead of paying dividend, they prefer to return the earning inside the company. So they usually pay no dividend or low dividend in order to achieve high growth opportunity. So if this is the case, usually for high growth company, they have low dividend yield and high capital gains. So the takeaway from his equation, the gain from stock investment, there are two sources. One is dividend payment, another is capital gain. Okay, so then we can quickly calculate the stock's realized return. So let's see this simple example. So Mitsui Bussan, a Japanese firm, pays dividend 80 yen at the end of each year. So if you bought it at the end of last year at the 1,600 yen, if you sold it 1 year later at 1,900, so the realized return should be, write down the gain in the nominators, dividend plus capital gain. So 80 plus 300 divided by 1,600, your initial investment. So your annualized return is 24%. And if we decompose the 24%, we can see that 5% are coming from dividend yield 5%, capital gain is 18%. Okay. Now, after reviewing the how to calculate the realized return for bond and stock, let's learn something from the market history. Okay. Due to copyright issue, I think it's difficult for me to share the slide for you. So please kindly allow me to explain through this video. So this is the realized return for U.S. Treasury bill, short-term bond issued by, you can simply think as U.S. government, okay, the Treasury. And x-axis is the year, y-axis is the total annualized return in percentage. So as you can see, yes, there are some up and down. Sometimes it's around 4%, sometimes it's 14%, okay? But importantly, there's no negative value, right? So realized return cannot be negative for US Treasury bills, okay, as long as the US government don't default. This is for the US Treasury bill. And this is the long-term government bond. In the previous slide, it's the short term, or in other words, less than 1 year, can be 3 months. But long-term government bond, as you can see, because maybe this bond is 10 years bond, so the annualized return can be positive and can be negative, because if the bond, the interest rate increase, then bond price will decline, okay? So this will lead to capital loss. Anyway, the main point from this figure is that for long-term bond, their realized return is higher than on average, the realized return is higher than the previous one. Okay, for the short-term bond, short-term Treasury bills, on average, maybe 4% or 3%. But for the long-term bond, it's around, it's difficult to say, maybe 10% or 8%. And sometimes you might have negative realized return because long-term bond is risky. So they should have higher expected return. So this is for the stock, especially for the large company stock. So it's obvious compared to bond, up and down it's substantially larger for the large company compared to bond, because you can see the bond. So the worst situation is the minus 10%, but for stock can be minus 40%, can be minus 40%. So up and down, it's become bigger and bigger for large company. And the realized return is also larger for large company stock compared to bond. This is obvious because if the stock has higher risks, they need to provide higher expected return. So in order to provide higher expected return, they should have higher return in each year. And the final figure is about the small companies' stock return. So if you compare the large and small company stock, you can see the up and down. Small company is more risky because the worst is 40%, minus 40% for large company, but the worst can be minus 50%, and the best can be 150%. And for large company, maybe the best is 50%. So anyway, the main takeaway for the fourth figure is that small company stock is more risky than large company stock. And large company stock is more risky than long-term government bond. Long-term government bond is more risky than the Treasury bill. And because treasury bill is the risk-free asset, so it should provide the lowest return. And long-term government bond need to provide a risk premium, so a little bit higher return compared to treasury bills. And then common stock for large company, it's more risky than bond, so their return is also higher than the bond. And finally, the small company stock is the most risky one, so they should have the highest realized return or expected return. Okay, so here is a link. So let's check what is it. So I think this is the stock market return country ranking. So this is for 2017. So they calculate the average return for the whole market by the country. And the highest one is averages. So the realized return is 66%. And let's see some developing country in Asia. So Japan is 19%. It's good compared to the past. And Thailand, 12%. Malaysia is 5% in 2007. Okay, so I think each country has different country rates and different development about the market, so they should have different return. But anyway, this tells us that if you invest in stock markets, usually you are requiring higher expected return. And this is reflected in the higher realized return in the stock. Okay, so we already understand how to calculate the return for individual stock. The next one is we need to calculate the rates for individual security. So the rates of a security can be simply captured by the up and down. So if an access price or realized return has a large up and down, we say it is the high risk. This asset is risky, and this can be calculated by standard deviation. So that's the next topic, the rates for individual security. So if you only invest in one security, yes, I like Song game. And what is the appropriate measure for the risks of this individual stock? And it's variance or standard deviation. They're quite similar measures. So let's introduce variance and deviation. So if you already know you can calculate a variance and standard deviation, I think you can skip this part. If you forget or you haven't studied about the variance and deviation, please listen to my following videos. So I'd like to start a video and take another one. So hold on. So see you in the next lecture. Focus on the calculation of the variance and standard deviation.